Hey guys, David Robinson here. Welcome to the Apartment Investing Journey. Another week and another great guest. I'm excited to bring you someone that has some expertise in an area of commercial real estate, a little bit outside of our normal focus, but I think it's good for us to be well-rounded and understand different aspects of the commercial real estate world. And so, Neil Wahlgren, welcome to the show. I appreciate you coming on.
Thanks for having me, David.
Yeah, my pleasure. So Neil is the Chief Operations Officer at MAG Capital Partners and brings nearly 2 decades of leadership in operations and capital markets, having raised over 250 million in equity for real estate investments. Prior to MAG Capital Partners, he led a Bay Area real estate investment firm, closing several hundred million in projects. And before that, Mr. Wahlgren logged over 2,500 flight hours piloting the C-130 in the Air Force and Navy. Thank you for your service, by the way.
Absolutely.
Following combat tours to Iraq and Afghanistan, he concluded his military career as a lieutenant commander. And now Neil resides with his wife and son in San Francisco, where they enjoy flying and sailing. So, Neil, the bio is just a real brief snapshot of what you've been up to over the last decade or more. And so, I want to take some time and really learn a little bit more about your journey. And maybe we can start from when you were first exposed to the real estate world and how you got involved, and let's go from there.
Yeah, no, great questions. So my first somewhat happenstance exposure to the real estate side was actually right as I was coming to kind of a tipping point being a military pilot. You kind of hit this point where your commitment is up and you decide to either take a big retention bonus, stay for another 8 years, and then you're kind of committed at that point to, retire with the military and probably go on to the commercial airlines. And, I kind of looked at it and weighed it all out and decided, well, I don't know if I want to do this. Really, it's kind of a grind, and you do less and less flying, more and more kind of admin bureaucracy type stuff. And so the natural alternative at that point is most guys, in my shoes at least, would go on to, hop on with Delta or United and end up, having a full career as a commercial pilot. The military to commercial segue is a fairly common pathway for commercial pilots. But right around that time, I remember I talked to the one guy I knew that had gotten out of the cockpit and decided to do something different. And I was curious, right? I'm like, is this guy a fool, or does he know something I don't? And I remember chatting with him, this guy Conrad, and he had gotten out, and he was kind of dabbling into doing some of his own fix and flips, and he was kind of looking at potentially leveraging that to go in. This is about 10 years ago, to go into more of the financial market side, but he was passionate about it. And he told me, like many people, he'd handed me the Purple Bible and said, read this. It's a short read. It's quick and dirty. And then let's talk. And I did. I sat down and just poured through it. It took me like 36 hours, which is way faster than I read most books. And after I finished, all these light bulbs are going off. Nothing was connecting quite yet, but I wanted to learn more. And after some repeat conversations with them, I kind of knew then and there, spending the rest of my life, working for my hours and minutes in a cockpit certainly was not the way I wanted to go. And that was kind of the catalytic point that initially steered me out of the, probably path I had most inertia on toward this, really exciting field that, I'm in today.
So that's great. So, you referenced the Purple Book, the Rich Dad Poor Dad book. There's so many people that book has impacted and sort of led down this path of real estate investing. And it's cool that you had a friend that pushed you in that direction. So what were the steps that you took? There's probably some listeners that are in that place where either they've been exposed to real estate investing, or they've read about it, or they have a friend or a colleague or someone that's in this space that's investing that they might want to explore further. What were the steps that you took once you were sort of exposed to it and learn more about it? What were the steps that you took to actually get involved?
Yeah, that's a great question. So, when I first got out, I actually had spent a couple of years working in a startup down in Southern California, unrelated to real estate. But I was starting to kind of research on my own, and really kind of came to a critical fork in the road to say, do I want to just jump out and do this on my own, or do I want to potentially find a partnership? And the more I kind of read, and some people absolutely just dive in with both feet. But the more I read, and I've always been kind of around teams and in team environments. And, for me, I decided probably the best path for me was to, find someone who's doing this, learn under them for a short while, and then, basically grow organically with that, potential resource to really, help you leverage your knowledge increase and, leverage your experience quickly. So I ended up basically leaving Southern California, moving up to San Francisco, ended up syncing up with the husband of a family friend of ours that ran a equity focused shop toward commercial real estate investment. So the business model there was raise funds and partner with experts, operators, developers who had really niche expertise, who did it well time after time, had a proven track record, but maybe were growing too fast for their organic capital base, or maybe just were great operators and not great money raisers. So we would partner and basically become that investor equity arm through the lifespan of those investments. And that was, it was such a just deluge of information, and because we would partner with experts in multifamily and multi-tenant retail and senior assisted living. So really got to, not only raise money for those, but look under the hood and get super comfortable with the underwriting and see these different models and different, really just different sets of risk. And during that period, one of the operators we had the opportunity to partner with was Mad Capital Partners, who I'm with full time now.
Interesting. Okay. Well, here's the path that you've been down. This is great. I am interested in digging a little bit into that that equity firm that you first started with, and what that role was like for you, in the sense of, is this a boutique firm that's a few partners, or is this a larger firm where you're stepping in and playing a smaller role in the bigger picture? Maybe just shed some light on that. I think our listeners might be interested in that.
Yeah, it was definitely boutique. And, what I found in this space, I think slim is better for, basically the administrative and capital side of things. Ultimately, you see some of the greater failures in this space, realty shares and, some of the large, similar models, but take a big marketing budget and big headcount. Those are ones that have found themselves in trouble just because they have such a high burn rate that, if the market does take a stumble or a twist, they can find themselves over leveraged and, ultimately, fail. And then suddenly all the investments that they were managing become, subject to a set of risks that their investors probably never even thought of in that scenario. So yeah, I think we were about a half dozen full time with a few contract, but most of the manpower and headcount was really managed directly by our operator partners. So they, really the hands-on, the property management, the inspections, the lending relationships, all those would be handled by our partners, and then we were really just laser focused on that equity investment relationships, building that trust, those repeat relationships in order for us to be able to go to them and say, look, this is a new asset type, but we have vetted the sponsor well. Many times we had done previous deals with them, and that allowed the investor to kind of create some additional diversification. They knew us as a common point of trust, and we were able to provide, diversified commercial real estate into the portfolio all through kind of one avenue.
Yeah, love it. And so for you personally, as you were in that, navigating into that space without any prior commercial real estate experience, or at least, you had obviously been a part of a team with a startup in California, but unrelated to real estate. So you're sort of stepping into this new role. Yeah. What were you actually doing with that team as far as the equity side of things? Were you working with the existing investor database, or were you charged with going out and acquiring new investors and bringing capital to those deals?
Yeah, great question. It started off more on an operational role, just basically putting some systems in place to allow us to grow, kind of leveraging a lot of that operational, I hate to say it, but almost militant operational checklists and, standards, but they work, right? and bringing that into the company to allow it to grow, and then ultimately taking on those operator relationships, to be able to pull deal flow and secure the right kind of deals and do risk analysis, and then ultimately, take more of a hands-on approach on the capital side and how we raised funds and how we, basically introduced our brand to new investors.
Gotcha. Well, what a great deal for you to get involved in the business and really learn from a boutique firm where you would have the opportunity to have your fingers in a lot of different aspects of the business, but also something that was established enough where you weren't building from scratch. You had an opportunity to learn from someone else and the track record that they had. So take us forward from there. So one of the deals that you did and the partners, these experts in a particular area of the business, MAG Capital Partners, was one of those. Talk to us about how this transition from, being where you were with the equity firm to now working with MAG.
Yeah, so I had actually kind of risen through the ranks and eventually was acting as president on the boutique firm. And, having seen all these different, really seen the underwriting and seen, what I viewed as a different set of risk for different asset types, right? I mean, obviously everyone knows a development deal is probably going to have more risk than a, stabilized multifamily, but there's a lot of nuance in between and a lot of nuance between markets. And, really after several years of this, started connecting the dots. And MAG Capital had a very unique model in that they did almost exclusively Midwest-based real estate, buying single tenant net leased industrial space. So we're talking warehouse, manufacturing, B2B tenants that were in place, operational, and they would acquire these through sale leaseback. So ultimately the manufacturing companies would own the building and operate in that building. So they were the landlord and occupier, and they would effectively, for a number of reasons, they would sell the real estate to us, basically use the proceeds from that sale to reinvest into other parts of their business, and then simultaneously turn around and sign a long-term full triple net lease. And just quick review that the triple net lease means the tenant is taking really all the responsibilities, all the expenses of owning real estate. So they pay their own taxes, their own insurance, their own utilities, and in these cases, even their own building maintenance. So if you need like a new roof, new pavement, landscape, all that, the tenant's paying directly.
And are these the 30-year leases, generally speaking, in that range, 20, 30-year leases?
Typically 20 years, and they'll have, usually a handful of extensions beyond. And I mean, our usual seller in these scenarios is someone who's occupied the building, honestly, probably 30, 40 years on average. So they know this building, they've customized this building. This building has been, tweaked, innumerable amount of times to fit their needs exactly. And, really, they're just continuing to operate. They're continuing to pay their own expenses just the way they were before. Just the only difference is now they are a tenant rather than the owner of that building.
Gotcha. And so for you, as you're transitioning from the equity firm over to MAG, was it the business model or the business opportunity that was most interesting? Probably a combination of both, but I'd be interested in hearing your personal thoughts on why you decided to come and join MAG. Yeah, go ahead.
Yeah, it's a great question. Over time, when I first got into the space, I found I was attracted I chased returns, right? And I see this a lot with kind of new people to the space. You're like, well, I mean, why would I invest in this deal that's projecting 16% IRRs when this other deal is projecting 18%? And you chase the higher returns to go, well, of course, this is a no-brainer. And then after time, I started actually seeing these different investments kind of go full cycle and realizing, there's massive disparities and discrepancies in the risk underlying these projections. And to quote a broker I respect, he once told me, he said, "I never met a pro forma I didn't like." So
yeah, that's a good one.
And it's true because, a pro forma and underwriting, it is what it is, right? It's as good as the assumptions baked into it. And I mean, anyone can make an underwriting look rosy, right? And it's really, you need to know, the man or the woman or the team behind that underwriting to say, hey, are these numbers viable? Are these numbers conservative? Have they delivered on these numbers on past projects? And to me, that's 10x, 100x more important than, the actual economic projections of a particular deal. So for that reason, I'd looked at these teams, looked at their track record. Do they actually perform the way they did? Did they run into problems that they expected, or were they, completely, out in left field when things hit them by the side? And when I compared that across really a wide range, probably almost a dozen operators, I love the team behind Mac Capital. They're just, a solid group of folks. The team meshed well, communicated with themselves, communicated with their investors, delivered as promised every single time. I mean, that to me, I'm like, that makes money raising so much more fluid and so much more just transparent and honest, when you can look someone in the eye and go, yes, we have delivered. They're not home runs. They're, we deliver mid to high teen annualized returns for the most part, right? But they're above market, and they're considerably lower risk, in my opinion, because you've removed all the expense surprises of owning real estate, taken all those day-to-day, tax changes and insurance premium doubling. I mean, 1,000 things that can happen that you don't know yet, but you've removed that risk and put it on the tenant, such that your responsibility and cash flow as an owner is extremely predictable. And that was what drove me to that team and that model.
Love it. And so I do want to talk a little bit about sort of your thoughts. Maybe we could do, in your opinion, a comparison between multifamily and industrial and some of the pros and cons. You've already outlined a few just there, but I'm curious about what your focus is right now at MAG, and what your role is with the company.
Yeah, absolutely. So my position at the company is Chief Operating Officer. I run really operations and primarily capital markets. So, really the debt, the equity, ultimately, once we get a deal locked up, once we've negotiated purchase price and the corresponding lease in that sale leaseback transaction, finished the core of the due diligence, created the credit report, then it kind of goes over to my team, and we, basically take that, we, take competitive debt bids, we put together the opportunity and the underwriting for our investors, ultimately secure that capital, both from debt and equity, to fund these deals, typically in short spans. And we find, we're a lean team, we're about a dozen people, but we're able to ultimately outcompete a lot of bigger firms because we can move quick, we can close quickly, and really you have to find competitive advantages. And, ultimately, sometimes the highest price is not what a seller's looking for. And a lot of people question that, and they go, well, why wouldn't they do that, right? These commercial deals, on average, between when we first start negotiation to when we close, on average take 6 to 8 months. So imagine you're a seller and you take a gamble on just a slightly higher bid, and you waste 8 months of your life. And, the deal falls out, they can't get debt, the equity falls through. I mean, you might walk away with a tiny bit of earnest money, but at the end of the day, I mean, you'll be banging your head against a wall, wishing you had gone with maybe the more reliable team. And these, really experienced good brokers will steer their sellers toward, not necessarily the highest bid, but, maybe the most reliable bid. And that, similar to the housing market as well.
Well, I'm curious about that 6 to 8 month time frame. What causes those transactions? And maybe it's just when you're starting the conversation. Is it different than your traditional multifamily acquisition? Is there some nuance there that maybe our listeners should be aware of?
Absolutely. So, really, it boils down to where is the core risk in a single tenant industrial deal. So, I'll compare this to multifamily. Multifamily, you have a lot of tenants. You're going to assume some level of default, some level of occupancy. Renters are going to not renew, or you're going to have some evictions, some combination of it, right? And when new tenants come in, you're going to do a small amount of due diligence on them. Maybe look at a credit score, some general factors. But in general, you're taking a risk on the tenant. You're hoping they stay for a decent amount of time, but you're going to have a certain turnover rate. And the risk on those is really, it's the value add, it's the capital improvements, it's executing on the business plan after you buy the property to say, can I raise rents? Can I raise occupancy, build value? So industrial, on the other side, it's more of a defensive play. So you have a fully occupied building. You're putting in a new lease you've negotiated. That lease will have built-in rent bumps. So, rents are going up, you're at full occupancy. it cash flows really well. At this point, I just need it to stay that way. And the
Mm-hmm.
risk on that comes down to a tenant default, right? So if the tenant defaults on the lease, now my cash flow stops, and suddenly I'm in a much worse place than before. So these are not residential or individual credit tenants, right? These are, in general, most of these tenants do 60, 80, $100 million a year or more in revenue. They have strong EBITDA, low debt, but that credit picture, that confidence that we have that that tenant will really remain financially viable to continue paying the rent on time for roughly the 5 years we plan to own the real estate. That is the risk. So we do a huge amount of financial due diligence where we're building typically a 15, 20 page credit report on each tenant to say, hey, here we have done dozens of interviews with the C-suite, the executive team. We've looked under the hood, we've analyzed audited financials. We've built pro forma financial forward-looking statements to say when they sell us the building, they reinvest those proceeds. Are they paying down debt? How does the company look moving forward? What are the projections? And we really just lay that all out because that is the critical piece on whether this is a fabulous investment or this becomes, really a headache. And that amount of due diligence up front is what takes that additional time because you're building value contractually through that process and through the structure of the new purchase and sale leaseback there.
Yeah. Yeah. It makes a lot of sense. So as you're talking with investors that, and maybe just clarify for us who your investors are these sort of your individual accredited investors, or are you approaching more institutional equity? What does that look like for you?
Yeah. So most of how we raise is actually 506B. So we have a combination of, primarily accredited, but we can take non-accredited as well. And we actually kind of like having, strong earners that are looking for some, early relationships with operators to build that, long-term relationship with. We have family offices, not a lot of big institutional groups, but that's okay. We like being, kind of lean, having the right combination of investment partners in these deals. And we co-invest typically about 10, 12% of the total equity comes from our team as well. So we call it co-investment across the board. And, that's the model that we like to have.
And so a lot of those investors obviously are, I don't know if it's because we're more familiar with residential real estate, but it seems that the entry point for a lot of new investors in private equity starts in the multifamily space. Maybe they even dabble in some of the REITs and the easy stuff, but then transition into more of the private equity and investing in syndications. And so if you were talking to, and I'm sure you have these conversations with investors all the time, or at least your team does, as you're talking to an investor who maybe has some experience in the multifamily space, and I'm sure we have a lot of these listeners right now that are thinking, okay, maybe does it make sense for me to diversify a little bit outside of multifamily and into another asset type? You've touched on some of these things, but in your conversation with this type of investor who's familiar with real estate, familiar with multifamily, but wants to be exposed to other asset types, what's your discussion like with those individuals as far as potentially investing with you and your firm?
Oh, great questions. Ultimately, most real estate is a relative trade-off of appreciation versus cash flow. That ultimately, do I want year-to-year operational funds coming in, or do I want the potential for massive appreciation and my percentage of the profits to be my main value add, right? So, in multifamily, depending on the type, typically you're coming in, most opportunity is correlated or is coupled with a relatively low amount of upfront cash flow. So typically, even with a, say, 8 or 9 pref, you might only have cash on cash first couple of years of 2-3%. And that's with oftentimes IO debt. So you're really, you're kind of squeaking this thing through to make it even cash flow positive. And then ultimately you're relying on a lot of those assumptions and a lot of the execution of that business plan to happen afterwards. And then, then it's kind of a wait and see. Is the team the right team? Did their market research, was it correct? And then ultimately, you wait and see and hope that, that cash flow increases and that you create value. on this side, this is cash flow first. So we, like I mentioned before, we start with a very high degree of cash flow. And when comparing the two, I like to say, look, you should have a mix of both. You should have, cash flow oriented investments, because ultimately, I mean, if you're a passive investor, your goal is to offset your W-2 income with passive income, right? And the more cash flow and assets you have, the less you have to work, right? Or the more things you can buy, or some combination of it. And,
Right.
ultimately, let's say, if your target is to have half your income come from passive investments where you're not doing anything, that's a great early goal, right? And then maybe 5 years later, it's 75%. And then 5 years later, you don't have to work at all. And then all your income comes from passive investments. And if everything you put in is appreciation, you're not really chipping away at that cash flow goal. So for that reason, I think it's really important to have both, and establish relationships with operators such that, ultimately, I think doing a large amount of deals with a small amount of operators, absolutely the best way to go. Build up trust, find the ones that you like, that communicate well, and that, are in that journey with you. And then you can, really kind of establish that. So, I mean, just one last piece.
Yeah.
Me, myself, I have a large amount of my personal capital in these cash flow focused industrial deals, because I know them. They're close to the vest. I do, more due diligence in these as a sponsor than I ever would as a passive investor, and I feel good about them. But I still have about 25-30% of my portfolio in more appreciation focused stuff, like turnaround multifamily projects and some developments. So I think there's absolutely a case to be made for some of both.
Yeah. Love it. Well, this has been a great conversation thus far. I want to be respectful of your time and start winding down here. At this point in time, I'm curious about what the horizon for MAG looks like and what kind of impact sort of this economy that we're in, with a lot of unknown on the horizon. What is MAG focused on moving forward, and what do things look like for you guys?
Yeah, great questions. We found, I mean, no different than multifamily. We found, I mean, the market we're in is a bit crazy, right? There's huge amounts of capital flowing around, chasing deals. It's driving up prices. But what we have found is there's still opportunity in the seams. And what I mean by that is, we found major metros for industrial and sale leaseback. I mean, you have institutional groups, you have middle market groups, you have private investment groups, 1031s, all chasing a finite amount of supply in, name brand metros like your Dallas, your Los Angeles, coastal markets. It's most of Florida. And I mean, really what used to trade at an 8 cap is now at a 6 or even 5 cap. I mean, silly valuations, right? But we found, coupled with the right credit, we are willing to go a little more secondary, and sometimes even what I call commutable secondary, when it could be, 15, 20 miles outside of secondary cities. And these might be like, Des Moines, or, we just took one in the Quad Cities area near Davenport. I mean, these type of cities that are important for the states they're in, but maybe not well known on a national market. But what we find is, really a lot of manufacturing, you can still have fantastic credit. You can still buy in tight industrial markets out there. And, honestly, a lot of the big players won't even consider, non-primary markets like that. So, we're still finding opportunity in that space. From a track record side, it's proven to be a really strong bet on that piece. And, we always try to seek that right balance of, understandable risk with above market cash flow. And that's, that is our sweet spot. And that's what we seek to deliver. So, from that perspective, opportunity and deal flow has remained pretty strong. And, we're averaging roughly about 10 deals a year. So.
Oh, really? That's great. Good for you guys. Well, Neil, I want to start winding down here. I've got 3 final questions I've got for you.
Sure.
The first is, what's the biggest win you've had on your real estate investing journey so far?
Probably a deal that I partnered early with MAG Capital on. This is when I was with the previous firm. A deal called Gamma Aerospace, and it was in Mansfield. And that one was fun. I put some of my own money in it. Standard sale leaseback. It was an aerospace manufacturer. I loved it actually because they built parts for the C-130 Hercules that I used to
Oh,
fly in
really?
the Air
Oh, that's
Force.
great.
So kind of close to
No,
home.
no, no wonder you put some money into that
Right? I was like, I would never hear the end of it if I don't. But no, the company had just gotten acquired by a private equity firm. And that private equity firm was effectively looking to deleverage some of that acquisition cost by doing a sale leaseback. They hyper focused on the company, less interested in buying the real estate, right? So
hmm
they sell us the real estate and basically tighten or make the overall purchase price of that company smaller by selling off the real estate.
Mm.
We had a 5-year plan, and about 3 years in, this private equity firm was hugely successful in what they sought out to do, and that was grow the company, right? So they come to us and they say, look, we're out of room. But luckily, they had a lot of extra land, and we were able to actually transition the deal into a fairly significant value add. So we said, all right, we will build a substantial amount of additional square footage for you. We will be the GC, the developer for this, because we have that talent on our team. We're able to finance the bulk of that with additional debt from the original lender who loved the deal. And they're like, our tenant's getting stronger. This is win-win. And ultimately, I think the very small amount of additional equity we put in ultimately added this huge amount of additional square footage. We were able to increase the rents overall. And I mean, made what should have been, probably a solid double into what I consider a very strong home run from a return perspective to our investors. And it was great to be part of that because we felt like we were really instrumental in creating that value. And it really was such an alignment of interests where the company was able to grow the way they were, our investors did really well, and we got to, really make this building better for our tenant. And it was kind of a fun process. So.
Yeah, that I'm sure would appeal to your traditional multifamily value add investor too. There's sort of a component of the both there. That's great. Cool.
Yeah, we probably get that in about 1 in 4 or 5 deals. And we never underwrite around it because, you don't quite know if it's going to materialize or not. But we do, we work with our tenants and go, hey, is there any sort of, you're doing well, is there any sort of expansion that maybe we could partner with you on? And those, tend to be win-win all around.
That's interesting. The next question I got for you, what's the biggest mistake you've made on your real estate investing journey so far?
The biggest is just not getting started earlier. I honestly, I was in my early 30s before I even got introduced to this. And I'm like, I wonder what could have happened if I, on the flip side, I certainly don't regret the flying journey and, see a ton of the world and got some good stories to tell over beers. But, from a personal wealth and experience and level, this definitely has been just this journey and this space I'm in has been, for me, a great personal alignment in terms of, excitement and the right teams and just the right work-life balance. So, I try to share the word and, I have a 9-year-old son. I'm already trying to get him talking about real estate.
That's great. That's great. Good for you.
We'll see where it goes. But.
Well, the last question I've got for you is what's the best advice you have for someone that's just starting their real estate investing journey?
Yeah. Well, I mean, to touch on number 2 again, start early, sooner rather than later. I would say, honestly, so many people get kind of paralysis for that first step because it's a giant first step. And honestly, partner with someone. You don't need to, make a ton of money on the first deal. You don't have to make any money, actually. I mean, just partner and just say, look, pay my expenses. I'd love to just work my ass off, do due diligence, be part of this team through the journey. Do that once or twice. And I mean, the amount of experience and confidence you get very quickly, to me, is immeasurably valuable. So I think, from what I've seen, the more you can sync with the right team, your basically potential output is far, far greater than, kind of going at it alone or, in just say 1 or 2 people.
Yeah, love it. Great advice. Well, Neil, this has been a great conversation. I've really enjoyed it. Thanks for taking a minute to tell us about your journey, your experiences in the military and trying to make that decision of what path you go down after your military service. and then ultimately finding your way with the private equity firm, and then eventually transitioning to MAG and what you guys have focused on here at MAG. And thanks for giving us an overview of industrial warehouse with these triple net lease tenants and sell leaseback situations. It's always good for us to broaden our horizons a little bit, understand different asset types. And so I think, thank you for, breaking that down for us. What's the best way for our listeners to connect with you, learn more about what you and MAG have going on, and potentially invest with you on a future deal?
Yeah, you can just reach out direct. I'm pretty responsive on email. My email is Neil, Neil, at magcp.com. Or you can check out our website. We've got some resources on there and some easy ways if you're interested in joining our investment group. That's www.magcp.com.
Perfect. We'll have that in the show notes. So if you want to reach out to Neil, learn a little bit more about his business there at MAG, go ahead and click on one of those links and connect with him and his team. Again, Neil, thank you for taking the time and sharing your journey with us to help us all on our path. And I look forward to connecting with you again soon.
Sounds great. Thanks for having me on, Dave.